I think it makes sense for us to go over earnings as a catalyst, and we've got a couple small ones coming up, and we'll talk about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. So we do have some earnings coming up. A couple of these are well-known names. This isn't really the real kickoff season for earnings, but this week, I should say, on this holiday shortened week. And because it's a holiday shortened week, I thought maybe we can just take a look at a couple stocks. One that I kind of like here, not earnings related, but also take a look at some companies that have seen better days that are going to be reporting. So if you can see my screen right now, what I did was I just took a look at those companies that are going to be reporting earnings out of the course of the next couple of days. A couple of names stick out straight away. Consumer names, Nike, and Constellation Brands. Now, both of these companies, were sort of aristocrats for investors for a long time, and they have certainly languished for reasons of consumer preference, largely. So, I thought what I would do is just sort of take a look at these the way I might if I was doing this with fresh eyes. So I might say, let's see what's on the earnings calendar. Here are some names. What's going on in these names? So we'll start with Nike. What I just said is something that probably many of you already know, which is that this is a stock that has seen substantially better days. In fact, I actually had a video of my son, Sam. He was on Options Action on set in New York when he was little. It was right before Father's Day weekend. It could have been maybe 2018 or something like that. What I remember was that, maybe it was 2019, was that he said at the end of that show, buy Nike shoes, not Nike stock. That was like his closing trade. He was the guest trader. And it's rather astonishing to think that here we are, call it 7 years later, and the stock is significantly lower. Obviously, it's had a little bit of a roller coaster. It did have a big drawdown. That was the pandemic plunge that followed. Then, of course, it had that post-pandemic, we're all going to become sneaker collectors. And since that time, it has just completely melted down. Now, that meltdown is actually the function of two things, which we can take a look at here. I'm just going to graph some fundamentals. One of the things that is a function of is what's going on with revenues and earnings per share. So this is the revenue picture. It has seen better days. It obviously was rising quite steadily for a while and then has fallen off. But that drop is nowhere near as pronounced as the fall in the share price. We can take a look at earnings per share. We can see that picture actually has deteriorated more significantly. So even though revenues are higher, earnings per share are lower. So that is certainly part of the problem. And then we can take a look at the forward price to earnings multiple. And let me see here. So this is on the estimate. And I'm going to, just because this gets a little, murky if I leave those other things. And this is the other part of it. And what we can see is that a big portion of the rally that took place in Nike was not related to the underlying fundamentals, but rather that the enthusiasm for the shares was sort of mirroring the enthusiasm for the shoes. And people were willing to pay up. You know how shoes got collectible? Well, so did Nike stock. You can see that actually at its peak, right in here, it was trading at more than 40 times forward earnings. And I think this is illustrative of the fact that it is usually when things are, everybody's the most exuberant, that they are also, for the underlying product, that they can also be most exuberant about the shares of the companies that issue those things. And this is one of the reasons why, when you have so much enthusiasm, as we do for something like AI, that when you see that the share price is, that you have some meaningful appreciation. Actually, we won't pull up for the heck of it. I'll pull up something like Micron before moving on. You can see that you got this big spike here in Micron. Now, this has actually subsequently fallen off, and the reason for that fall off is because, as we saw last week, for example, when they reported that the numbers surprised everybody. So people were paying up, and then, in fact, the numbers even blew the doors off of those elevated expectations. But the cautionary tale that comes is when you start to see circumstances where the share prices continue to rise, maybe even faster than revenue and earnings do, in an ideal backdrop for the business. When that happens, it can create a lot more air underneath. And that is what happened to Nike. Now, the question that we have at this juncture is, well, at what point do we start kicking the tires here and saying, maybe we should take another look at this? Let me go back 20 years. 10 years, excuse me. So we're looking at 10 years. I want to see how far back we have to go to get back to the valuation we have here. And this is amazing to me. One of the best known brands. There it is. So this is approximately where the stock was trading in late 2014. And now we can just quickly compare. Well, all right. Well, what kind of revenues did the company have back in 2014 compared to what we're expecting it to have for the full year when they report? This is going to be the full year. So 46.3 billion, we'll use round numbers, is the number that the street is expecting for the full year. That's this number right here, by the way. I realize that sometimes when I show these screens, my eye is naturally drawn, but it's probably not as easy for you to see it. So if we go back to 2014. Oh, I've got this. How do I do? Oh, I can move that, I think. Can I take? Oh, I can't take it off. I'll put that in the upper right-hand corner. I'll do. Apparently, I have an icon that's obstructing things. So now we'll just go back to 2014. And we're at 27.8 billion. So 46.3, 27.8. Now, we've had enough inflation, I think it's safe to say, in the years since 2014, particularly in that 21, 2, and 3 period, that a dollar today is not the same as a dollar was then. But that's still a 66.5% increase in revenues. How about earnings per share? That's down here. That was $1.50 in round numbers. By the way, I also want you to pay attention to this section up here. I think this is, I don't want to gloss over that. I might sometimes, but the top line is the market capitalization. This is the cash and equivalents. This is the debt. And actually, normally you kind of want to, it's not the case in this example, but you want to combine, debt and debt-like instruments. And the difference between this and these things subtracted from the market capitalization gives you your enterprise value. So that's basically saying, okay, I want to take a look at the business, but not factor in the the net cash, you basically want to take a look at, so you're basically adjusting for the capital structure of the business. $2.1 billion in free cash flow. We'll go back, and here's where we begin to see some problems. In inflation-adjusted terms, the free cash flow is probably lower this year than it was in fiscal 2014. So that is a little bit of an issue. What else is a little bit of an issue? Well, $1.50 a share, which is the trailing 12 months, and also approximately what the street's expecting here. So I'll just use 41 and a half and $1.50. So 27.7 times. Here's the amazing thing. As much cheaper as the company has seemingly become, it isn't really, because the fundamentals have been deteriorating pretty materially. And it does appear that there is some anticipated improvement, but not tremendous. Now, I have said this before, and this is more true of cyclical business necessarily than it is for a business like this. You may have heard me say from time to time that companies often look cheapest at the top of the cycle, and they look richest at the bottom of the cycle. What do I mean by that? What I mean is that if you take a look at something like a trailing earnings multiple, or even just a forward earnings multiple, that multiple sometimes will compress at the top of a cycle as investors appropriately anticipate that the cycle could come to an end, and that therefore the operating performance of a business might deteriorate, and they might seem like a very high multiple at the bottom of a cycle, which also makes sense because you can imagine that if you had a highly cyclical business where you had gangbuster profits in one year and suffered losses the next, well, if that was a cycle that was generally upward trending and people's expectation was that that was going to continue, then when business was really good, investors are saying, yeah, I know it's good now, but, it's lumpy, so it's probably going to fall off at some point. And when it's really not going well and there's no profits or even losses, they're still willing to pay something for the business because they're anticipating that in the long run that will recover. Now, in the case of Nike, maybe some of you know better than I, because I don't shop for Nike shoes, and that I think is where they get a good percentage of their money. Is this going to rebound or not? My thinking when it comes to consumer products, I've often referenced something I call the Holly Index, which is take a look at the family credit cards, see what people are buying, and if they are buying a lot of something consistently and maybe even buying more and more of it, this is one of the reasons that Lululemon showed up on my Holly Index for a long time, is that my wife and seemingly most of her friends shopped there continuously and just bought ever more and more stuff, wore it all the time. And it came off of my Holly Index a few years ago when she pivoted and started buying Vuori products, became her favorite product. Now, Vuori is not a publicly traded company, so it didn't get added to the index, but I just thought that was interesting. Vuori purchases essentially displaced all the Lulu purchases on the American Express bill. Okay. So that's a reasonable question. So I'm not going to make a judgment about whether it's going to turn around, because to me, that's a question that people who are more tuned into the consumer can make. So instead, what I have to do then is say, okay, well, does that mean that if I trade options, there isn't something for me to do here? And one of the things you're going to see is that the implied move is much bigger than the long-term historical average move has been. And I apologize for all this sniffling. I was just actually outside. I don't know whether I ingested something I might be mildly allergic to, but please forgive me. I was out with the dog. So to me, I look at this chart and I think, well, there's certainly going to be some investors at some point who are going to start to say to themselves, you know, this thing has completely round trip this extraordinary period, and it's probably worth buying at some level. And then there's a lot of other people who are going to take a look at the fundamentals the way we just did and say, you know what, I'm going to wait, I think, for them to show definitive signs of progress, that they're turning things around. So with that in mind, and knowing that implied volatility has risen, I think I might want to get short a little bit of premium. So as we think about that, one of the things we probably want to consider is what does the vol surface actually look like? And we can see that the near-dated options are quite elevated in price, a function, as you would expect, of the upcoming catalyst. And I actually don't know that the company is going to completely and fully resolve what is coming up next. I also think that there's a decent chance that the stock could move if the news is bad. It has been moving quite sharply, but I also want to sell volatility. This is one of those circumstances where, and I probably didn't load it up already, did I? What do I have here? I have the New York Stock Exchange's website up. The reason I had the New York Stock Exchange's website up is I was trying to look for a way to screen for ex-dividend ETFs today. But I'm going to pull up options play. And oh, one other thing I want to just quickly take a look at, which is we were just taking a look at Nike's earnings. Let's also identify when the next one takes place. So we know that there's about an 8% move. We've got June options and we've got SEP options. Okay. So ways that people can short vol in a name like Nike, going into the print, hoping for some vol crush. The most obvious would be sell a straddle. Sell the call and the put of the same strike and expiration. The thing is that if you sell the straddle, I'll build that in right here. Sell that, we'll add a put, sell that. Yeah, I mean 42 days. Let's see what we got here. 53. Yeah, that's probably fine. Okay. Oh, that's 45. We don't want that. We want to go to close to at the money. So that'll be the, I guess the closest is the 42 and a halves. You end up with a structure like this. Downside break even of 36.40. And it might be worth just taking a look at the long-term chart because that would be new, fresh lows for the last, 14, 15, 16 years. Or to the upside, 48.56. My thinking is that the probability of profit could be improved somewhat if you said, okay, well, rather than do that, I'm more inclined to, let's say, sell a strangle. And selling a strangle, maybe I would choose something like a 20 delta call, and it's not exactly a 20 delta call available, and maybe a 20 delta put, something like that. Now you end up with a structure like this, pays you about $1.86. $1.86 over the course of 53 days on a $41.50 stock, 3.76%, which works out to about an annualized return of about 25.9 or thereabouts. This is a mid-market price, so we'll just call it 25 to be a little bit more reasonable. Give some room to assuming that probably going to need to hit some bids here or there. The problem, though, with this trade, which I actually like in a lot of stocks, is that when you go into a catalyst, that is when you sometimes get some very painful outcomes. I'm reminded Federal Express. What year was that? I want to say, it's probably 3-4 years ago. Their end of year quarterly earnings worst outcome in 30 years, and the stock just had an absolute disastrous return. So now you're looking at this strategy saying, okay, well, I want to be short that strangle, but I don't want to take unlimited risk. Now, unlimited is technically correct. It's unlimited risk because you're selling an upside call and a stock can theoretically go to infinity. In the real world, they don't really, but I get that. And also there are margin requirements to a position like this that might be a little bit onerous in some circumstances. And some people don't like the idea that, okay, maybe I sell the strangle and I'm completely unhedged. If it goes down and then I'm assigned on the put, I own the stock at a discount because I'm going to own it at the $37.50 put spread, less the $1.86 that I collected. So I'm actually going to end up owning it at, $35.70 ish and change net of transaction fees, call it. So that's okay with me. But on the other side, where if you get naked short a stock and there's some kind of a squeeze or something, that can get uncomfortable. Things you can do. You could just say, I'm going to sell a call spread instead. At yield max, that's how the funds look to collect premium against the single stocks that they hold. Own the stock or a proxy for it, sell upside call spreads, collect some premium, and if something really strange happens and you get an extraordinary upside event, and why don't we just quickly, as I say that, talk about how often that happens. So we'll just take a quick peek at a histogram. Now you're looking at a situation like this. Now this was 53 days. We'll call that 53. That's like 35, 36 sessions probably. See if I can jack this a little bit and make it roughly equivalent. So now we're looking out to that expiration. So this is a comparable amount of time. And you might say to yourself, I'm willing to sell a call spread. And here's why I'm willing to sell a call spread. Because these types of events actually don't happen with great frequency. It is these events out here on the wings that seem to happen with greater frequency than we would otherwise expect. And I want to hedge against that. So, by the way, and this does not really look like the distribution I'm about to describe this as, but when a probability distribution has more events congregating around the mean, like this, and more happening at the wings, like we have out here, than normally would happen, than a normal distribution, that's the orange line would suggest, that is called kurtosis. This is a leptokurtic distribution. When more happens in the middle and more happens at the wings than a normal distribution, that is leptokurtic. If instead it's the opposite, where you have lower and flatter, so it goes maybe like this, that would be mesokurtic. So you like to sell call spreads because you're essentially, most of the time you're going to get this kind of a situation. More often than not, it's going to hang around here, and you're going to be able to capture these gaps. And in those instances when it does this whole thing, now you're hedged because you have the upside call. So that would be one way to do it, and not an unreasonable one. So what you would do is you would just simply add a long call to that strategy. But another way to do it is with the old strangle swap that I have talked about before. So I'm going to add another call. I'm going to add another put. So we got a call and a put here. Nice. And I want that to go out in time further. And I want it to capture the next earnings event, because what I'm anticipating now is, remember, I'm expecting that the near-term volatility is overpriced. I want to capture that. And so what I'm going to be doing is saying, all right, you know what? To hedge that risk that I just identified, I am going to trade a little something like this. I'm not expecting it necessarily to linger right here, but I'm going to get a shape that looks a little bit like this one. Because, and now, no, my break-evens are not a whole lot different than they were in the other case. They're a little bit broader. So remember what we had as a downside break-even at expiration of the first range of options. It was going to be 35, I think a 35.70-ish or so was what I had referenced. And my upside break-even is going to be up here around 55, which is considerably higher than that other strategy would be, just the short strangle would be. But also, the maximum risk is limited to the amount of money that I spent, which in this example is $2.08 approximately per structure, or a grand total of about $208 as each options contract represents 100 shares. So you can put on a $200 bet, and if it does one of these things, you can win in here. Comes over here, you can win that way. If it lands somewhere in the middle, probably not the best and happiest outcome. Might be a push. But this is a way you can try to sell that strangle, but take out that unlimited risk element. And, I will also offer that this kind of a strategy is a useful one, I think, for people who are, starting to trade options to do, because you start to better understand the dynamics of how options prices behave as a function of the price in the underlying asset, as a function of things like catalysts, as time passes. All of those will end up playing into this, and happily you have defined risk, right? So, $200 ish, a little bit more, I guess. The equivalent of buying five shares of stock. You could do something like this, and it's a good exercise for better understanding the behavior of options positions. And I've just remembered I forgot to bring up the comment section here. Okay. And actually, we've got some questions. So maybe before I can go on and start talking a little bit about Constellation Brands, but I can also take some questions. Let's see. Finwest. Hi, Mike. Who takes the other side of my options trade? We always talk how market makers hedge to take a customer order, but when am I trading with a market maker versus another retail customer? And the answer is almost always. Almost always you're trading with a market maker. And the reason, the simple reason is that as much options trade, and a lot do. Let's see how many options traded today. We'll just pull this up. We can use our handy dandy trade alert from SIBO. Show Henry Schwartz's wares. And we'll just take a look. What happened today? So across everything, we traded 71.1 million contracts. On average, there are corporate actions that adjust this, but in general, the options we're dealing with here, and this is index, ETF, single stock, the whole kit. In general, most listed options in the United States in the equity sphere, and I'm including index in that, have a multiplier of 100. So that's roughly the equivalent of 7.1 billion shares traded. A lot. The thing is that the smallest denomination you can trade is effectively the round lot, right? So you can trade one options contract. So that means that the number of actual trades is going to be smaller because not every trade is going to be a one lot. And we can actually see that over here. So in terms of the total number of trades across all products, there were 11.6 million individual transactions. Okay, so where am I going with all this? And why does this pertain to the likelihood that you're interacting with a market maker? Well, we're just looking at Nike just now, okay? And actually, let's get more specific. So I'll drill down to Nike, and we're going to say, okay, Nike did 22,000 trades today. 22,000 trades. And look how many options there are in Nike. I mean, we're just scrolling down. This is just the earliest expirations, right? So only showing you the options that expire this week and next, and it's all this. And these are all the expirations we have. So every line is two options because it's the calls on the left and it's the puts on the right. Okay? So is it possible for you to interact with a customer order? It is. But the reason it's much more likely you're interacting with a market maker is because the likelihood in those 22,000 trades that took place in Nike today, that if you decided you were going to go and buy an option or sell an option on some strike, whether a call or a put, of some expiration, at the exact same moment that another customer was saying, I want to do the exact opposite. And so it isn't quite like two bullets hitting each other in the middle of a firefight, or two ships in the night colliding with one another. I will say that the probabilities are better than that. But it's a much higher probability that you don't interact with a customer. It's much more likely that you interact with a market maker. And this is even more true once you start dealing with what we call complex orders. What's a complex order? Complex order is simply when one security transaction is tied to, contingent on, or a part of another. So we just did this strangle swap. If you decided to do a strangle swap, so I'm selling a near-term strangle and I'm buying a long-term one, and you decided, I think I'm going to do the 37.5, 45 in August, and then I'm going to choose the October 35.50s, like that. So now the probabilities of you meeting up at exactly that exact same moment with somebody who's doing the other side of that trade, that is virtually nil. That is like two bullets hitting each other. You're interacting with Jane Street or Susquehanna or IMC, almost certainly in that case. That's okay. There's no reason why that's a problem. And you see what the market makers are willing to do at any moment anyhow, right? So it's sort of what a lot of people will say is the advertisement. It's the only advertisement that the options market really has is the prices at which you can buy and sell. And this is kind of interesting. In the days when I was a specialist, when I was a market maker in equities and indices, we used to have maximum spread rules. And what that meant was that depending on the premium of an option, you could not make your bid-ask spread wider than a certain amount. Now, when I first started to trade, and this will date me somewhat, I know, the minimum bid-ask spread for any option was an eighth. That's right, folks. When I started in the business, we traded in eighths, quarters, 3/8 to a half. That's how we did things. Shortly thereafter, they introduced what we then called teenies, which was a half of an eighth, 6.25 cents, right? So then we started trading in eighths and teenies. Now, those maximum spread rules don't seem to apply. I very frequently will see bid-ask spreads that were much wider than any we were permitted to make back in the day. I'm not 100% sure why that is. I suspect that it probably began as a quote mitigation issue. So this is going to seem like a very strange thing, I'm sure, to a lot of people, but we ran out of bandwidth to push quotes. This was starting to become a problem. When was it an issue? I guess it was in the late 90s, going into 2000. The exchanges all had their own proprietary systems. And the four principal options exchanges at that time was the Philadelphia Stock Exchange in Philadelphia, the American Stock Exchange in New York, 86 Trinity, the Pacific Exchange which is about 8 miles, or was about 8 miles over my right shoulder. If you drew a line from my right shoulder through Alcatraz, you'd land in the Embarcadero, which is where the Pacific Exchange is. And I'm not talking about the one that got turned into an Equinox gym that's featured in The Pursuit of Happiness with Will Smith, and the SIBO, which was formerly known as the Chicago Board Options Exchange. Now, mechanically, and I don't know if this interests you at all, but I'm going to share it nevertheless because you can't say no. In those early days, the quotes were pushed essentially by one primary market participant for any given underlying. So if you wanted to, for example, to trade Dell options were single listed on the Philadelphia Stock Exchange floor. There was a specialist who is a market maker, sort of like a specialist. If you don't know what that is, they're the ones that actually drove the quotes. So if you ever looked at an equity floor trading post, you would see some people around the post. They were the ones that were pushing the quotes out. And then you would see other market makers lingering around, or traders, and they were part of the crowd. And the specialist would push the quotes, and the market makers would all make markets in an open outcry kind of a way. Meaning, Dell's trading $50. Somebody comes in and says, broker would come into the crowd and yell, July 55 calls Dell how? Something like that. And the crowd would turn around and yell out, they would say 2 to 3/8, and somebody else would say 2 1/8 to a half, or something like that. And so you'd get everybody sort of, the best bids and best offers of all the market participants. And they would be, the best bid and offer in the crowd would be at least as good as what you saw on the screens, but could actually be better, right? So, and then the broker would find the best bid or the best offer, and execute that way. And oh, by the way, this is kind of important too, I guess, is that, if you're sitting there saying, oh, well, that's just crazy, you had to trade an eighth wide, those bid-ask spreads were wide, or they had to be a quarter or 3/8 or a teeny, 6 1/4. That did not mean that we didn't trade in the middle. You could trade in the middle. We would trade on splits. So, if something had a pricing increment of a teeny, so it was, 1 to a teeny was the market, and somebody really wanted to buy them, and someone said, I'm at 103, $1.03. If it was a big order, you could get very close. How do you do that? If you could only print at $1 and a teeny, you would trade it on what we call splits, meaning that you would trade a certain amount at $1 and a certain amount at 1 and a teeny until the average price for the whole lot worked out to whatever the desired price was. So, just because those quotes were wider didn't mean that you couldn't trade in the middle. Now, why does that matter to the current bid-ask spread that I'm talking about? The reason is that the wider the bid-ask spreads are, and the fewer market participants there are, so you had one specialist pushing quotes in Dell, a very actively traded option in its day. You had a lot of people making markets, and you could trade at any price you wanted. But the price that would get displayed on the screens would have to adhere to whatever the pricing increments were. So when it was eighths, 1 to an eighth, 1 to a half, 2 to 3/8, or whatever, what that meant was that as the underlying price moved, the bid-ask spread on the options might not move as much or as often. And what ends up happening is, if you live outside this world, you don't think about it too much. But now imagine, you fast forward to today. Now instead of having one specialist pushing a quote, so one computer terminal sets a price where the edges don't move that much, even though the inside might be moving, but what you see doesn't move very much. Now every market maker pushes a quote. They're absorbing every tick in real time. They're generating the new fair value for the option. They're pushing new bids and asks. And all the market makers are doing it. And they're doing it across more stocks, across more strikes, across more expirations, on a multitude of exchanges, because now we've got tons of them. I don't even know how many we have now. I think it's like 13, 14 exchanges. Could be more. All of a sudden, the amount of quote traffic has exploded. Absolutely exploded. And this became a problem. So in the 90s, late 90s, and I think into the early aughts, the exchanges had to come up with quote mitigation strategies. They were saying, okay, we don't actually have the capacity to push this many quotes. And I can very distinctly remember being told what the quote traffic limit was. I remember being told that the quote traffic limit at one point was you can't push more than 8,000 quotes a second. And so in order to stop pushing quotes, we had to say, okay, well, we won't update quotes on some options as often. So maybe really far out of the money puts and out of the money calls, we won't push quotes on those. But something else you can do is widen out the spreads again. And I'm imagining that it's entirely possible that one of the reasons that the lit markets started to go wide might have been a quote traffic issue. Could be also a computational issue, because you can imagine that if you're really tight, that means you have to reprice very precisely all the time. There is another issue still, which is that everybody's been in this big speed race, getting faster and faster trading transactions. And as that happens, you become increasingly vulnerable. And I could go down a rabbit hole of market structure issues here. But all of the exchanges have different rules. All of the market makers participate on most of those exchanges, which means that if I'm Susquehanna, or, like my old firm, we made markets on every exchange. And sometimes in the same security. Often, actually, in the same security. Because you didn't want to see it trade away, right? So something you wanted to trade, you didn't want it to trade away on some other place. So you wanted to be represented everywhere. And that meant now that you're not just pushing quotes in one place, you're pushing them all over the place. And on top of that, your counterparties are getting faster and faster. And because of the way the respective exchange rules work, if you're a market maker, you have incentives to show more liquidity in one place, because that's what the exchange was doing to try to drive traffic to their marketplace. And, to be the first at the best price, so what we call time, place, priority, might be a rule on another exchange. So you always wanted to be the first one to show your best price so that you would be selected first if a trade came in. There's some other places where it's simply pro rata. Pro rata meaning that, and that's where liquidity comes in. If it's pro rata, that means that whatever percentage of the lit market you represent, that's the percentage of an order that comes in that you'll get. Now, what ends up happening is that the market makers are now pushing quotes across a multitude of exchanges. They might be actually showing more lit liquidity than they actually want to trade. And because of that, speed becomes an issue, because if you get hit in one place, you got to say, oh, I got to yank my quote in the other because I just got filled. And so a lot of these dynamics, I think, are at work here. But that's who you're interacting. You're interacting with people who do what I used to do if you trade options most of the time. And here's your follow-up question. When market makers are involved, I feel like it's take it or leave it. But another retail person might be emotional and willing to give up a nickel just to get a fill. What goes on behind the scenes? So take it or leave it. This is really interesting because I interact with market makers all day. And let me see if I can, I don't know if it's going to, this will be interesting. I want to see if I can, forgive me, I'm going to have to pull something up on a different screen because some proprietary information might pop up, which I cannot show. Let me see if it's after hours, so I don't know whether I'm going to be able to do this or not. But I might actually be able to, you get to see how this works real time. That'd be kind of interesting. I don't know if it's fun or not. Let me see here. Let me see if I can pull up an example. Can I do an RFQ without an order and build a ticket? Oh, beautiful. Beautiful. All right. I'm going to ask the producer. No, so that's what I was looking. I'm just making sure that there's nothing proprietary on here. Yeah, it doesn't even show a security, nothing like that. Okay, so sorry guys, I just for understandable reasons, there is some information that goes on within financial institutions that cannot be shared, but there's some part of the process that can be, and I think this is rather important. So, or it maybe it answers your question. So what you are looking at, you just say, well, this doesn't look like anything. It's just a black box with nothing in it. Well, here's the thing. I can build a structure in here, like an options spread, as you can see. Like what we, maybe I can even, let's just do a strangle. Okay. And let's, you know what? Let's do it for real. Can't do it for real. The market's closed, but we're going to do it kind of for real. So I can then say, all right, let's say I wanted to do that August strangle that I was talking about earlier, right? So I say, okay, I want to sell those puts, and I want to sell these calls, like so. Okay. Now, this has got to be, I wonder if I can blow this up a little bit, make it a little easier to read. Can I do that? Is that getting better? Oh, okay. There we go. Okay. So I can now build this strangle and, okay, yeah, I want to sell this to open, sell to open, and I want to trade, I don't know, 500 of these things each. Okay. So that's the structure. I want to build that deal. Now, I interact with market makers all the time. You can see there's a bunch of them down here. Citadel, Jane Street, Susquehanna, IMC, and so on. And I can ping those market makers, and I can send them this structure. And I can send them this structure one of two ways. I can send it to them such that they already know what I'm trying to do, which is, in this case, sell it. Or I can send it to them in such a way that they don't know what I'm going to do, which is to say, make me a two-way, meaning a two-way market on this thing. Now, all of these guys now get to decide, well, if they know I'm trying to sell it, they can say, okay, well, here's my best bid for 500 August 37.5 50 strangles in Nike. And there can be more RFQ counterparties. Like, you can load this up with whoever you want, assuming they know who you are. And then you can basically go in to negotiate with them. They will respond. You can say, oh, I want to send it to him and then all these guys. I hit the send button. What's going to end up happening then is it's going to say, they're going to see my interest, and they're going to start to bid on it. They're in competition with one another. And then I can just choose the guy who has the best price. And so it is not take it or leave it completely. And and the only reason I'm not going to take it any further than that is that I think that first of all, the market's closed, so there's nobody actually waiting to respond to RFQs. That's called an RFQ, a request for quote. So in the institutional world, we have what we call IOIs, which are indications of interest, and we have RFQs, which are requests for quotes. Indication of interest is basically just letting the world know, hey, if you're trading Nike shares, I have an interest. And that indication could come with a direction. Like, if you're shopping a big block, and, typically when I was doing sell-side work of this sort, and people could come, they could ask me and other traders, like, will you make a market on the stock, or will you do some of it just to get us going? We did not take any equity orders that were less than 25,000 shares, because there wasn't much purpose in trying to negotiate. Like, the market's moving faster than the improvement in execution would likely do, and a lot of that kind of stuff just gets VWAP'd anyway. But if it was a tertiary name, meaning didn't really trade that often, and you had a big block, So that would act less likely to be something like Nike, which trade 27 million shares. But if you have a stock that trades, 3-4 million shares a day, and you're trying to trade a million shares of it, you cannot just click trade that. You have to negotiate with other dealers, with other institutional counterparties. Not so much what we do now because we focus mostly on options, and that's mostly dealers. But you shop it around, and so you would use an indication of interest. In RFQ, you interact mostly with dealers, and they'll make a price, and you can actually go into negotiation with them. If one of them responds, I actually have a mechanism where I can just click a messaging function in it and chat directly with that person and say, I'm a nickel away. Even because I haven't reflected a price. Remember, mine's a request for a quote. It's not me showing an offer. Can you pay a nickel better? I can do that. And they can say yes or no. And if they say yes, we say it's done. And we put it on the tape like that. So market makers can negotiate, and they do negotiate on bigger orders, but they don't on smaller ones, and that's just because it's impossible. There's 70 some odd million contracts trading like that. So you really can't do that. Finwest, thanks so much. It's fascinating to hear the background. I remember trading in fractions. Yeah, I mean, that was a big thing, by the way. When you started as a market maker, when I did, that was one of the things that they would do, is that, the new trader trainees, you would just be asked. You just had to drill that because it was open outcry. So you had to be able to do that in your head and do it fast. You had to be able to add up and subtract different options contracts at their respective prices so that you could make a market quickly in the appropriate quoting denomination. Now, this may also interest you. I also was let's see. Let's take a look here. Okay. Generally, how do you evaluate cyclical companies when you focus on growth? You mentioned Micron, but also looking at Corning. Looks cheap on a forward PE, but hard to buy after the run-up. Yes, that's a great point. Great point. Here's the way I think about it. One of the things I think about is the laws of large numbers. The laws of large numbers state that something like Micron, let's take a look at Micron. Micron cannot continue to, something that cannot happen will not happen, right? The anticipated top-line growth for Micron Technologies is 250% this year. 250% is the year-on-year anticipated growth. Now, if you have something that's doing 130, and look, they're expecting that to then double the next year. Well, even at this slower rate of growth, nearly doubling, so 250 to 500 billion to a trillion to 2 to 4. You see where I'm going? I'm not going there because that's not possible. The entire economy only does about 32, 33 trillion nominal per annum. And if it was growing at this rate, it would surpass the size of the economy in very short order. We would actually be able to see it here. So I can expand out to the left and take a look at this. So it's expecting, the street's expectations are that it does $250 billion in revenues in the next fiscal year, because this one's just about to end, so next fiscal year, and it's expecting $292 billion in revenues for 2030, 3 years later. So that is 17% growth over 3 years. So you're talking about 5-ish% nominal. So that's not even inflation adjusted. So I think you have to sort of say, okay, what's the way most people think about this is they think about the total addressable market. How big can the market be? So that's a decent place to start. And how much of that market do I think they're going to command? And then you handicap that a little bit and say, well, they say they're going to own 40% of the market, and they say that it's $1 trillion market. And you're like, $1 trillion? Maybe I'll cut that in half. I think you're being a little ambitious. I think it's going to be $500 billion. And I think at best you're going to own, I don't know, 30, 40% of it. 40% would be 200 billion. And so then you look at this forecast up here of 291 and you're like, I think that's just too ambitious. Because you've already sort of, you can't know this with great precision. Maybe some people are better at getting to a precise number than I am. Actually, correction, I'm sure that there's a million people who are better at getting close to a precise number than I am. But what you can do is you can start fencing off and cordoning off areas that well, that's just out there. That's not going to happen. And maybe you end up with something that's just too wide to come to a conclusion. Or maybe you get to a conclusion where you say, you know what? In the box of possible outcomes that I see happening, we're getting awfully close to one of the edges of what I think is possible. So if I can bet in the direction where there is more room, that makes sense. Because I think we've kind of eliminated a bunch of possibilities, and so we have to expect that the future is going to live in what remains. And then I can begin assigning probabilities. That's kind of the way I think about it. A cyclical business that I think is an interesting one to watch is, look at Deere, John Deere, one of the oldest publicly traded companies. And, of course, they're diversifying a little bit and they have more businesses, but at a high level, they sell tractors. They sell tractors to farmers. So Caterpillar does a lot of construction, but, Deere has a lot of forestry equipment. They do ag. And one of the things that prompts farmers to buy more equipment is the price of the goods that they sell. So crop prices, cattle prices, whatever, less cattle prices, I guess, but more, on the crop side. That's going to propel it. Interest rates propel it. Tax incentives may or may not, depending on whether they are better or worse from one period to another. And, the average equipment age, right? So if that there's been a dearth of sales and that the equipment is aging and you start to see that rates are falling and you start to see that corn and soybean and wheat prices are rising, well, it's a pretty good bet that there's going to be a lot more orders for combines in that environment. But you never shoot that to the moon, right? Because everybody in America is not going to go out and buy a combine. Only the farmers are going to do that. So there is a limit. There's a functional limit. So in that box that I was just describing, you have these dynamics that you can observe, and you have a universe in which you can sort of define the parameters. You know that some equipment is going to fall. It's just going to age out. It's going to wear out. They're not going to stop growing. So some of that stuff's going to have to be replaced. And those are essentially the boundaries, right? And so you end up with something that's kind of, and I think you can apply that to other industries. That one's maybe a little bit easier in some respects to do that because it's the kind of thing that you could probably work out if you spent a couple days thinking about the different moving pieces. Now, that doesn't get you to where valuation is, right? So you still have to sort that out a little bit. But I think you see where I'm going with that. Is that when you're trying to figure out a market, that there are ways that you can do that, things that you can look at. MDM, I think it comes down to discipline. I will not buy or sell an option at the limit I set. If it doesn't fill, I cancel. That, I think, is a good idea to a degree. I traded a bunch of options for one of our funds today. And some of the options we were trading expire at the end of the week. And because of that, there were prices at which we were willing to do some of these trades at 9:45 this morning, and that the price at which I was willing to do those trades changed by 12:45 this afternoon, because there's only 6.5 hours of trading per day, and we only have 4 trading days, so I'm looking at 26 hours. 26 tradable hours between now and the close of business on Thursday. So whether I'm buying straddles or selling them, the price at which I'm willing to buy or sell something is going to change as time passes, just because I know that those options are decaying away. And it's changing because the price of the stock is also moving. So some people will delta adjust the price. In fact, that's actually how institutions do it. You give a reference and a delta to the option. So you say, I'm 3 bid on a 30, ref 89.10. So that means that I'm 3 bid with the underlying stock at 89.10, and for every dollar that the stock moves, the value at which I'm willing to buy or sell is moving by 30 cents. That's 30 delta. So 30% of the price change in the underlying. And that's a very common way for institutions to do it. And institutions have to do it this way because if you're just trading a 20 lot and it's a nickel wide on the screens, 20 up, what are you doing? Just use this sucker, Put your mouse, click it, be done. But if you're trading, our head trader, a guy named Scott Snyder, and Quinn Berry, people like this, these guys are trading millions of contracts a week, and you cannot click trade that. That is not possible. You need to negotiate. You need to be, know your surroundings. It's a little bit different. So, anyway, I hope that helps. Finwest, I do some price discovery, throw a small order at a mid price and see what gets filled, maybe or maybe not. That's a great idea. If I have an odd lot to do, this used to be more true than it is now, but if I had an odd lot, I always used to use a price in the middle. And here's why. Because in the old days, the specialists on those exchanges that had them, and I'm sure this was true for the lead market makers on the exchanges that use that as a process, were obligated to at least satisfy the lit market, the listed bid or the lit bid or offer for a 10 lot. And so what that meant was if you were executing, let's say, a 1 lot or a 2 lot, you could go in at a mid-market price, sometimes just above for a seller and just below for a buyer, because you knew that it was easier for a dealer to just take that thing out and get it off of there than to deal with it. So if I was, 1 to a quarter, we'll make a nice wide market to keep it easy. I'm 1 to a quarter, someone's at 1 1/8 on a 1 lot, and I'm like, I don't want to sell 9 at 1 1/8. I really don't care. It's worth 1 1/8. I'll lift it. I'll take the 1 lot at 1 1/8, and I'm back to 1 1/4. So that that was something that would happen, and I think that is not because the market makers are not held to minimum size. This is not going to work as well. But I do think that if you live somewhere in the middle on small size, you're very likely to get a fill. We were going to talk about Constellation Brands, but I chewed up the whole time talking about the strange mechanics of market making, and so I've squandered your hour. You didn't get to hear about Constellation Brands. The liquor business is not so good these days. But Tucker, D-Dog, sometimes I do price discovery. Usually I discover I can't afford the price. Funny. Yes. If you have to ask, that's what J.P. Morgan said when somebody asked him about how expensive yachts were. If you have to ask, you can't afford it. Yeah, he was a big yachtsman. I don't know if you guys knew that, but I think he had a series of yachts, all named Corsair, like Corsair 1, 2, 3, 4, if my memory serves me correctly. I read a book about J.P. Morgan. There was a couple books that were written about merchant bankers and some of the other stuff, but that will have to be a topic for another day because I've chewed up this one. Like, subscribe, notification bell, put your comments and questions into the chat. Thanks for watching, and as always, we'll see you here. Thanks for watching.